is there truth to this idea? Or is it one of the market's most misunderstood myths and pearls of wisdom? All right. So in May, we've got Star Wars Day. It was just last week. There's Cinco de Mayo, also last week. Mother's Day coming up this weekend. Touch on a little bit later. Memorial Day coming up at the end of the month, but I'll also touch on a little bit later. Now, none of those holidays are as lucrative as Easter or Thanksgiving or Christmas, but neither are they disastrous. So why do investors have this deep-seated hatred for the arrival of May? It comes back to two words: summer vacations. So the sell in May concept originated in England, and that was when aristocrats, bankers, other wealthy elites, they would flee the suffocating heat of London and they'd go summer in the countryside. And they wouldn't return until after the St. Leger Stakes, the final race in the British Triple Crown. And that took place on September 15th. But here's the deal. Such a potent quotable, right, that knows no borders. So it carried over to the US where, hey, it just so happens most people take vacations between May and September, right? The idea is investors pair their exposure to the markets in these months by having their money take a vacation as well. That means a summer lull, as I've kind of talked about in the past, as volume sputters to a trickle, and it wouldn't normalize again until after the summer ended and children went back to school for Labor Day. I have sometime around Labor Day. Now, for decades, sell in May, this theory seemed efficient enough. Right? If we go back from 1950 to 2020, the Dow Jones Industrial Average averaged a meager 0.3% return from May to October. Meanwhile, those same blue chips, they went on a charge from November to April, gaining an average of 7.5%. Most of you guys may or may not know, but the Hirsch's, Jeffrey Hirsch, Stock Traders Almanac, they made very famous that November to April holding period. And when we look back, at the stretch for the Dow, and we look at the stretch of the average monthly gains for the Dow since 1993, we do get this sort of period here where, May through September rate doesn't look very promising. 3 of the 4 worst months of the year for stocks occur in that 5-month span. But a lot of that damage is weighted to the years between, 1998 and 2011. Nearer term, the story is a bit different. In fact, let me just go back to this chart here. Since 2013, the average return for the SPY, once again, the SPDR S&P 500 ETF, from May through October is 5.4%. That's actually better than the average 4.96 return that we've seen from November through April during the same span. Of course, that does include, the bear markets as well as the huge, massive market collapse in 2020. But I just like to kind of show that everyone is now connected to the markets 24/7, 365, even on vacation, whether it's May or in November. Investors can still place trades. All right. So the one thing I do want to point out is that despite all of that, the month can be prone to some of these notorious swings. But the reality is the Dow has only ended May with a loss 11 times since 1993, right? So that's 30 years, only 11 losses. That means blue chips have ended the month with a gain 63.3% of the time over the last 3 decades. The fact of the matter is January, February, June, August, and September, those are all worse months for stocks than May. And since 2013, the Dow has only ended May with a loss once. So with that being said, we can see that, when stocks do fall in the month, they will fall hard. Particularly since 2010, we had these 3 losses over 6% during that decade and some change. I like to point that out because it's worth taking note again, because we still have the possibility that with the debt ceiling talks that are underway, if you do see some headwinds, it's not too bad. Historically, May marks the beginning of kind of a difficult stretch for the Dow and the S&P 500, but a lot of that has to do with the cyclical nature of industries like retail and shipping. But since 2013, or since 2003, the SPY has only exited May with a loss 5 times. There's a 75% success rate. Average gain is 0.64%, which isn't great. Meanwhile, the Invesco, the QQQ Trust, is averaging a gain of 1.53% in the month over the past 20 years. And then when we look down here, we see that the iShares, the Russell 2000 ETF, is averaging a 1.06% gain in May since 2003 with a 65% success rate. So sell in May and go away. I wouldn't be doing that, right? Nothing in the data shows that. It's one of those months that investors really like to pay attention to, but you don't really need to be concerned about it.